Welcome. Today, we're diving into a really big decision for UK landlords in 2026. Should you go for a fixed or a variable rate mortgage? Now, this isn't just about your monthly payments, not at all. It's actually a massive strategic tax move that could make or break your profits. And to help us get this right, we're using the fantastic analysis and deep insights developed by the experts over at Pro Tax Accountant, so you can make a much, much smarter choice. All right, let's kick things off with a question that might just shock you. If you're a higher rate taxpayer, is it possible that your property is being hit with an effective tax rate of over 50% on its actual profits? The answer is yes. And it's all down to one single tax rule that has totally changed the game for landlords. Okay, so here's what we're going to cover. We'll start with that huge tax challenge I just mentioned. Then we'll look at the bigger economic picture, compare your two main mortgage options, peek at what's coming down the road in 2027, and finally, we'll lay out a playbook for you to make the smartest move. Right, first things first. We have to understand the problem your mortgage choice is trying to solve, and that problem has a name: Section 24. Honestly, if you're a landlord and you don't know this inside out, you really need to. It's probably the biggest financial hurdle for individual landlords right now. So, what is it exactly? Well, in a nutshell, Section 24 completely changed how your tax is calculated. It stops landlords from deducting their mortgage interest costs from their rental income before they work out their tax bill. And what that means is you're now essentially being taxed on your turnover, not your actual profit. The impact can be huge. Let's just look at the before and after because it makes it really clear. It used to be wonderfully simple, right? You took your rental income, you subtracted your costs, including your mortgage interest, and whatever was left was your taxable profit. Easy. But now you have to calculate the tax on your income first, and you only get a basic 20% tax credit back on that interest afterwards. And here's where it really bites. Let's look at the real-world numbers. Say you've got £15,000 in rent and £5,000 in mortgage interest. Your actual profit is 10 grand. A basic rate taxpayer pays £2,000 in tax. But look at the higher rate landlord. They're facing a tax bill of £5,000. That's a staggering 50% effective tax rate on their profit. This is the Section 24 minefield in action. Okay, so with that pretty major tax problem rattling around in our heads, let's move on and see how the current economy is creating this central dilemma for landlords in 2026. So the big picture is that interest rates are expected to fall. After a cutback in December 2025, pretty much everyone is expecting more cuts during 2026 as inflation hopefully calms down. Most forecasts are pointing to a rate somewhere between 3 and 3.5% by the end of the year. And this, right here, perfectly illustrates the choice you're up against. At the start of 2026, you can see a 5-year fixed rate is looking pretty competitive at 4%. Meanwhile, a tracker mortgage is a little bit higher at 4.18%. So the big question is, do you lock in that rate for certainty, or do you take a chance on a variable deal, betting that those base rate cuts actually happen? All right, let's explore that first option. Think of it as treating your mortgage like a fortress, something to protect you from all the uncertainty out there. Now, to make this real, let's meet Priya. She's a freelance graphic designer, a higher rate taxpayer, and for her, financial predictability is absolutely everything. She needs to know her exact costs month in, month out, no surprises. For someone like Priya, a fixed rate is all about control. Her interest payment is the same every single month, which means no nasty surprises on her tax return. It also helps her avoid something called bracket creep. That's where a small rise in income accidentally pushes you into a higher tax band. Plus, with Making Tax Digital coming in for many from April 2026, having a fixed cost just makes that quarterly reporting so much easier. So the bottom line for Priya is this. With a fixed rate, she knows her exact tax liability for the next 5 years. And that means she can budget and plan with complete and total confidence. But what if you're willing to take on a little more risk for a potentially higher reward? Well, let's look at the alternative path, the variable rate opportunity. Okay, now let's think about Mark. He's a small business owner, he's got a few properties, and he's comfortable with a bit of calculated risk. His number one goal? To maximize his post-tax profit. Now for Mark, the tax strategy is much more dynamic. As the Bank of England cuts its rates, his tracker mortgage payments fall. This is key. It actually reduces the negative impact of that Section 24 tax gap, because with lower interest costs, less of his income is being unfairly taxed. The result is a direct boost to his net return. So Mark starts the year with this tax bill. But, and this is the crucial part,
If rates fall as predicted, this number will actually go down over the year, putting more cash back in his pocket. Now stay with me here because the next point might surprise you.
Okay, time for a quick pro tip. What about those hefty mortgage arrangement fees? Well, you can't deduct them as a business expense. However, and this is important, they do qualify for the exact same 20% basic rate tax credit as your mortgage interest. It's a really crucial detail that helps soften the blow of those fees. Now, whatever you decide for 2026, it isn't just about this one year. It is absolutely vital that you look ahead, because there's a major change already locked in and scheduled to happen. As you can see on this timeline, there's a bit of a storm gathering for April 2027. We've got the recent rate cut, we've got Making Tax Digital kicking off, but the big one is that scheduled increase in tax rates specifically for property income. So get ready for this, because your tax bill is set to rise. As you can see, the basic rate on property income is going up from 20 to 22%, and the higher rate is going from 40 to 42%. Now think about it. If you take a 2-year fixed deal in early 2026, it will expire just as these higher rates kick in, and that could create a really significant financial shock. So, we've looked at the problem, we've weighed up the options, we've peeked into the future. How do you pull all of this together to make the absolute smartest move for your own situation? Ultimately, it boils down to this one simple trade-off. The fixed rate offers certainty and simplicity. It's your defensive strategy. The variable rate, on the other hand, offers the potential for lower costs and a way to actively shrink that awful Section 24 tax gap, but it definitely comes with risk. And this is probably the most important takeaway, a direct quote from the experts at Pro Tax Accountant. There is no single right answer here. A strategy that is absolutely perfect for one landlord could be a complete disaster for another. So the final question is really for you. Which path feels right for you? Are you more of a Priya who absolutely needs that certainty to sleep at night and plan effectively? Or are you more of a Mark, ready to take a calculated risk to seize an opportunity? As you've seen, trying to navigate Section 24, shifting interest rates, and future tax hikes is a real challenge. So please remember that all the information here is for general guidance. It really shouldn't be the sole basis for your financial decisions. Before you make any big moves, we highly recommend you consult the experts at Pro Tax Accountant. They can properly analyze your specific situation and create a strategy that's tailored just for you. You can reach them on WhatsApp or by phone at the number on your screen, or drop them an email. Thanks for watching, and make sure you subscribe to their channel for more of these essential insights.